Welcome to this deep dive. Today we are dissecting this really abrupt risk-off transition in the Bitcoin market as of July 13, 2026.
Right, yeah. It's a very tense situation.
It is. And the mission for you listening is to look at the market data, on-chain movements, corporate filings, all of it. Because they all point to this severe defensive liquidity crunch.
Exactly. I mean, usually you expect this market to be an ocean, right? Broad order books, deep liquidity, capable of taking a hit.
But right now we are looking at a puddle. I mean, Bitcoin peaked at 64,427 and then just fell off a cliff down to 62,442.
Yeah, the order books are just incredibly thin right now.
Right, and it wasn't some huge macro shift that caused the drop. It was literally one dormant whale from 2018 waking up and moving 2,931 Bitcoin. That is like $188 million.
Which is wild. Moving that much ancient supply in a thin market.
It's like trying to park a battleship in a dinghy slip, right? The displacement alone is going to cause total chaos. But wait, does this point to an imminent over-the-counter block sale, like an OTC liquidation?
Well, probably. You can't just click sell on a public exchange with that kind of volume. You negotiate a private block trade directly with an institutional buyer to avoid tanking the price.
Right, obviously.
But the actual sale almost doesn't matter here. The mere threat of that battleship displacing the water is enough to panic a fragile market.
And that's the thing. The displacement is so devastating right now because there's barely any water left in the harbor. The overall liquidity water level is just rapidly dropping.
It really is. We have seen this massive contraction in stablecoins.
Like a $10 billion drop just since May, right? With Tether losing $6 billion and Circle losing $7 billion.
Yeah, because we are in this higher for longer traditional interest rate environment. Holding non-yielding on-chain cash is just too expensive now.
Okay, but let me push back on that trend for a second. Because major banks were practically falling over themselves recently, predicting a multi-trillion-dollar stablecoin market by 2030. So why is capital fleeing so violently right now?
Well, it comes down to immediate opportunity cost. Stablecoins generally don't pay you yield. So when traditional risk-free interest rates are sitting this high, keeping your capital in zero-yield digital dollars bleeds potential revenue.
Oh, I see.
Yeah, capital allocators aren't abandoning the technology. They are just defensively seeking yield in traditional markets. And that strips the crypto exchanges of their bid-side depth.
Which makes total sense. So the macro capital drains out, leaving the major corporate players scrambling to build defensive moats. Look at MicroStrategy. They just added $450 million in cash reserves.
Right. Well, their massive position, which is over 843,000 Bitcoin, sits roughly $9.7 billion underwater.
Wow. And Michael Saylor even posted that cryptic update about the orange dots telling only part of the story.
Exactly. Those orange dots traditionally represent Bitcoin on his charts. By saying they only tell part of the story, he's quietly acknowledging their pivot to hoarding traditional fiat dollars.
Right.
They need that cash buffer to survive.
Definitely. And it's not just treasuries taking a defensive stance. The infrastructure providers are struggling too. In Europe, the new MiCA regulations literally just wiped out 83% of local crypto service providers.
Because MiCA demands institutional-grade compliance. The strict capital reserve requirements and auditing costs are massive.
Too much for the little guys.
Way too much. Small providers are shutting down, and even industrial miners like LM Funding are abandoning Bitcoin entirely to pivot to AI data centers just to survive.
It's just industrial pain across the board, although it's wild to contrast that pain with what's happening at the retail level. A solo miner using a tiny $150 BitTax device just beat 1 in 6.5 million odds to win a full 3.138 Bitcoin block reward.
Which is an incredibly fun reminder of how the protocol's lottery mechanics work, but it really just highlights the stratification. The spot market is too illiquid and risky right now. So the structural friction is shifting to the derivatives market.
Right, the derivatives turf war. Because spot liquidity is drying up, and now CME Group is suing the CFTC over their fast-tracked approval of Kalshi's perpetual futures.
Yes, because CME argues that perpetuals don't expire, so they aren't technically futures at all. They are swaps.
And swaps require incredibly rigid compliance, right?
Exactly. Massive daily collateral adjustments and strict reporting that Kalshi isn't burdened with right now. If Kalshi loses, over $1 billion in onshore perpetual volume could immediately unwind. It's a huge point of fragility.
So to pull this all together for you listening, we're navigating a highly defensive environment. We've got evaporating stablecoin liquidity, corporations hoarding fiat cash,
Yeah.
and a high-stakes turf war over derivatives.
It is a market totally focused on capital preservation right now.
Yeah. Which leaves us with a final thought to ponder. We are seeing traditional assets successfully migrating on-chain, like Ondo Finance tokenizing BlackRock ETFs.
Right.
If the water level for native crypto is dropping, but traditional finance is actively building pipes to the blockchain, could the next great market expansion bypass native digital assets entirely? What if the future is just using this infrastructure strictly to trade traditional equities 24/7? It really makes you wonder if that battleship we talked about is actually obsolete.